Hi, and welcome to the bottom line. Nifty has been hitting all time highs, and so is the bank Nifty. The most important and full of dilemma question that comes out is what do we do in such cases? Today, in this short video, I'm going to explain how I assess all time highs. This is a very personal way of assessing, keeping it very simple and trying to assess all time highs in the most efficient possible way. So, if we look at the current situation, this is how I have assessed it. So, at this point, we have India is closer to the interest rate peaks, inflation is looking to stabilize, companies are reporting good earnings across quarters. Again, there are always a set of companies which are not performing and some of them are performing, but broadly, if we see the Nifty 50 companies, which are all strong market cap companies, are broadly performing. The geopolitical concerns remain. What is happening in the Eastern Europe and all of the areas around it, the war is slightly a concern, but somewhere I feel that business as usual is not affected in India because of that. So that's the assessment of where we are currently. But in all of this, one of the most important aspects is valuations. And when I say valuations, you can look at it from different ways. There are a variety of ways of doing valuations. There are a variety of ways of understanding a value of a company with different techniques that are available in the market, that are available, with all the knowledge that people have gained. One person I know who's one of the masters in valuation is Aswat Damodaran. You will see him having a YouTube channel, and he's explaining about valuations on various companies. Uber turns out to be my favorite on that one. But in case of Nifty, where it's not a company, it's an index altogether, there is a way to understand valuations. So if you look at the current chart that you see right now, the numbers are only up to 2022, the end of 2022, but the current 2023 numbers are close to 21, right? Now, these numbers would, you're looking at it in terms of the colors, that there are some of them are very light green, some of them are dark green, some of them are dark red, right? And they are colored based on the average value of Nifty over the past 20 odd years. When I say average value, this is price to earnings, which is also known as P ratio. You will see a lot of people mentioning about P ratios across YouTube, but the correct way of understanding a P ratio is that if there is a P ratio of 20, that means for every 1 rupee earnings revenue that the company is making, the investor is ready to pay 20 rupees for that as a premium price because he believes that a company is expected to grow further from there, right? If we try and understand average Nifty P, and I've taken the data all the way from 1999 to 2023, and the average P is about 20.89. That means over the past few years, the investors in Nifty have been open to paying 20.9 rupees for every 1 rupee earnings that companies make, right? Now, this sets a very important tone for understanding where we are while we're making these new highs in Nifty. If you look at 2021, the highs in Nifty were, close to around, if you see this number, which is 40.52, they were close to around 40 PE, and it was slightly overstretched from where the average was. So it was 2 times the average PE of Nifty. Now, that is definitely alarming. But what is it this time is an important aspect to understand in assessing all time highs. So, this is how you interpret that number, which I already explained. And as we are making all time highs, look at the PE ratio. The PE ratio is 23.96, which is hardly 2 or 3 rupees away from the long term average. Now, long term average means a lot and holds a lot of weightage because it has been so much of data, so many cycles, but yet Nifty investors have paid 20 rupees, right? And everything above the standard deviation of 1 standard deviation or 2 standard deviation. So the standard deviation for Nifty is 4.51. That means the way I'll start going into the red zone is 20.89 plus 4.51 goes about 25, add another 5 goes to 30, add another 5 goes to 35, and then 40. So these four bands of four standard deviations is what makes the overvaluation heat up. So from here, if you look at it, everything above the red zone, right, where you're seeing above 35 and above, is truly an alarming situation. And if we would have been doing all-time highs with 35 as the p valuation of Nifty, it would have been alarming. But where are we? We are at a meager p of 23.96. Again, this is not a number that's latest. About 4 or 5 days ago I took this number out, but that's what we're seeing. And this, you don't need not check every single day. It can be done once in a quarter, once in a month. It does not change too much, right? But if you start seeing rapid movements in Nifty, but with valuations hitting, what does it mean when I say valuations hitting? It simply means that the underlying companies are not making enough money, and still the investor is saying, I'll pay a premium. That is fundamentally incorrect, right? Why would you pay for a company that is not making enough earnings or not having enough earnings growth? That's the basis of the whole analysis. So, broadly, from this entire analysis, I'm convinced that Nifty is preparing towards a well-structured bull run. It's not immediate. You would, I would question so many fundamental issues with the economy right now, with the interest rates, with the inflation. Have we peaked the interest rate? Too many problems and too many things to be questioned. I definitely comprehend that. But when Nifty is making these all-time highs, I'm also looking at, while the issues are getting resolved in the background, are the valuations good enough for me to continue a few investments that I do, right? Is it good enough for me to hunt for new stocks that are good in valuations, that are good with earnings numbers, and that are in a state of dissolution as compared to its earnings, right? And that is what is the whole aspect. Whenever I do, is I have this very small checklist that I follow, and that checklist is what I've presented today. So just go through the p numbers, look at the all-time highs, and see how far we are from the average p of Nifty. Now, this average is the average number today. So this is going to change 10 years down the line, 5 years down the line. So you have to be uh, good at going and fetching the latest numbers always, so that you can compare correctly. And then see, where are we? Are we with one standard deviation? Are we with two standard deviation? Or are we overhitting? Or are we going in too much discount as compared to it? So too much discount is also a fantastic situation where I can think of putting a large sum of money and making good returns from it. So I hope this was useful and insightful, and I hope this helps you in every time when Nifty makes an all-time high. This does not happen too often. This has only happened 4 to 5 years in the past 30 odd years of history of the Indian markets. But when it happens, assess valuations and see where we stand with a broader average picture. Thank you so much, and I'll see you in the next one. Bye bye.